Welcome to Accounting 101 Synchronous Seminar for Chapter 3 for Spring 2015 semester. Tonight we will be talking about Chapter 3, Accrual Accounting and Income. I often make a joke with my students in the classroom by week 3 when I say, what kind of accounting are we doing in this class? And some people say ACCRUAL or they're not quite sure, and I say it's a cruel kind of accounting. It's very, very cruel, and that often helps students to remember that the word is accrual accounting, which means we will be recording receivables and payables, recording revenue when earned and expenses when incurred. And we will go through this slide, and then I have a little Excel sheet that I'll show you some examples on. Just make sure if you have any questions as we go along that you raise your hand. I'm going to, I need to go check email to see if anyone's having any trouble here getting in real quick, and then I'll be ready to go. All righty. Okay, so again, we are going to talk about accrual accounting and income, Chapter 3 in your textbook. I hope to have a little bit of time. I want to flip up some pages and give you some pointers on how you can improve your quiz scores as we go along. So the first learning objective in this chapter explains how accrual accounting differs from cash basis accounting. Cash basis accounting is the type of accounting that we typically do as individuals. When we pay for supplies, then that's when we would record the expense for those supplies, or when we receive our paycheck is when we would record that we had received that paycheck. So some of the ways that this difference, accrual accounting differs from cash basis, is we record the impact of the transactions when they occur. Accrual accounting is actually required by generally accepted accounting principles, or GAAP. And again, I had said this already, but you'll hear me say it over and over and over. We record revenues when earned and expenses when incurred. And so I'm sitting here and I'm saying record. We record. What does record mean? Record means that I actually journalize the transaction. I would determine what account I debit, what account I credit, and record that in my general journal. Cash basis accounting, on the other hand, records only cash transactions, whenever I get the cash or when I pay the cash. It ignores lots of important information, like when was that cash earned, or when was that expense incurred. And the results are incomplete in financial statements, and this is only used by the smallest businesses. You would not want to use a cash basis accounting if you were a very large business. How does accrual accounting affect our cash flows? Remember that the cash flow shows where the cash that's in our company cash account comes from and where it goes. So accrual accounting, when we collect cash from customers, it's different. Accrual accounting records cash transactions. We record the cash from the customer, so it's an account receivable. We receive cash from interest earned. We pay salaries, rent, or other expenses. We borrow money. We pay off loans. We issue stock. Anything that we do, we get cash coming in or cash going out. You have to remember, though, that accrual accounting is going to also record non-cash transactions. Sales on account, meaning accounts receivable would be my debit and sales would be my credit. Purchases of inventory on account. Inventory would be my debit as an asset, and accounts payable would be a credit as a liability. Accrual of expenses incurred but not yet paid. So this would be an adjusting entry, which is where we're headed with this chapter, with adjusting entries and closing entries. So if I am recording or accruing an expense that has been incurred but not yet paid, that might be my utilities expense for the month. I've used the utilities, I have the bill for the utilities, but I'm not going to pay that utility bill till next month, so I would record it as a utility expense and a utilities payable. And usage of prepaid rent, insurance, and supplies. So again, this is something, it's a deferral that's been on my books. I recorded supplies as an asset, prepaid rent as an asset, prepaid insurance as an asset. And now I've used part of those up. It's the end of the month and I've used up part of that. So I need to take it out of my asset account with the credit and put it into a supplies expense or an insurance expense or a prepaid rent expense with a debit. Earning of revenue when cash was collected in advance. So in our chapter so far, we basically have run across one liability account that doesn't end in the word payable, and that might be unearned revenue. So if I had an unearned revenue, that's a liability because someone has paid me cash in advance to do a job for them, which I have not yet done, and therefore I owed them the work or I owed them the money back. That makes it a liability. And once I have actually provided that work or part of that work, I need to reduce the liability with the debit and put it into my revenue with the credit. You want to remember that a fiscal year can end on a date other than December 31st. Many companies end their fiscal year on another date, including Walmart, The Gap, JCPenney. A lot use January 31st as retail businesses because that's a slower point, and they like to do some of their accounting office work when it's not so busy recording sales and such. When we are using accrual accounting, we need to consider the time period concept. The accounting information is reported at regular intervals, so we do our financial statements monthly, and then we have maybe a quarterly or a semi-annual and an annual financial statement. The basic accounting period is always 1 year. Around 60% of large companies use a calendar year from January 1st through December 31st. And then again, remember, fiscal year may end on a date other than December 31st. And companies also prepare financial statements for interim periods. So that's a year, a term that you will see and hear out in the real world. They'll say the interim financial statements. So an interim statement is any time that it's not the end of the year. Learning objective 2, we talk about applying the revenue and expense recognition principles. And again, this is just basically, in basic layman's term, it's when do I recognize my revenue and when do I recognize my expense. Recognize meaning record or journalize. When do I make that journal entry to put it in my journal? More terminology for the same thing. So the revenue principle actually deals with two things. When do we record or recognize the revenue, and what amount of that revenue should we record? So revenue is recognized when the business transfers promised goods or services to a customer in the amount that reflects the cash or fair market value of other consideration that the entity expects to receive in exchange for those goods or services. FASB and International Accounting Standards Board have both issued a joint standard that provides a consistent, converged, and simplified way to recognize revenue. The selling entity must identify the contract with the customer, identify the separate performance obligations in the contract, determine the transaction price, allocate the transaction price in the separate performance obligations in the contract, and recognize revenue when or as the entity satisfies the performance obligated. So Exhibit 3.1 in your textbook shows two situations that provide guidance on when to record revenue for Starbucks. So if I'm Starbucks and I have a customer who tells me, I plan to start drinking Starbucks drinks, and Joe here tells her, well, we'll welcome you as a customer. Is there any revenue in that point? At that point, no transaction has occurred. The customer just says they think they're going to start buying it, but they haven't bought any yet. And in the second situation here, it's the customer says, "A latte, please." And "I appreciate your business. Here's your latte." When that latte is served, the revenue has been recognized or recorded, or should be. The expense recognition principle looks at all the expenses incurred during the accounting period. It measures the expenses and recognizes them in the same period in which any related revenues were earned. So if I recorded my sales revenue for January, I want to make sure that I have all of my salaries expense that was earned in January recorded in January as well. Even if I withhold my pay for 2 weeks, I would, if I do withhold for 2 weeks, I may be paying that 2 weeks into February, but it should be recorded as an expense in January and matched against the sales for January. So we have another little exhibit in our textbook. If you want to look at your textbook or if you want to look at your slides, you can see that Exhibit 3.2 illustrates expense recognition. And we often call it the matching principle. If you're around very many practicing accountings, you'll hear us throwing out the term the matching principle. And the matching principle is really the combination of the revenue recognition and the expense recognition principle, of where we want to make sure whatever expenses it took to earn that revenue is matched against it. So that's what this slide here is illustrating. If we have $1,000 worth of revenue and $800 worth of expenses, we have a net income of $200. So let's see if you can come up with the answer to this for me here. Remember, if you have questions, you're welcome to ask those questions. Hi, Travis. Didn't see you earlier, but I see you're there now. So you're making up for the missed class, huh? So let's stop and think about this. A customer pays Starbucks $250 on March 15th for coffee to be served at a party in April. Has Starbucks earned that revenue yet? When will they earn the revenue? So this happens to be a prepaid or unearned revenue, right? If you want to type answers in the question board, you can. Let me see. First, I have to find it. Okay. Or you can ask questions by typing a question in the questions link if you have a question. And Starbucks pays $6,000 on July 1st for store rent for the next 3 months. Has Starbucks incurred an expense on July 1? So in the first number 1, they did not earn that $250 until April, when the party actually occurred. So it was an unearned revenue recorded in March, and then it would have been adjusted in an entry in April when it was earned. Starbucks paid the $6,000 on rent. On July 1st, there was no expense incurred. On July 31st, there's an expense. An expense has been incurred and would be recorded for $2,000. So that brings us to adjusting, and that's what I've been talking about when I'm talking about the prepaid rent that was paid on July 1st. On July 31st, that we would have a $2,000 expense on July 31st. We would need to record that before we did the July financial statements to make sure that they were up to date. Adjusting entries are journal entries made to ensure that revenues and expenses are recognized in the proper accounting period. Again, we want to make sure that we adhere to the matching principles using the revenue recognition and the expense recognition principles. Generally made at the end of the accounting period, so last day of the month. So you're going to see your adjusting entries on January 31st, February 28th, March 31st, April 30th, May 31st, etc., all the way throughout the year. And every adjusting entry, and this is an important thing that can help you to get your answers correct when we are working on our journal entries, is that every single journal entry will include one income statement account and one balance sheet account. What does that mean? That means we'll have a revenue or an expense. You can laugh at my writing here. Right? Or an asset, liability, or stockholders' equity account. And it's typically going to be an asset or a liability. Okay. As we look at Freddie's Auto Services as for an example here, we have an unadjusted trial balance. What does an unadjusted trial balance mean? That means that we have done our journal entries for the month. We have posted them to our ledger, and then we have taken the totals from those ledger accounts and put them into a trial balance. We have not yet completed our adjusting entries. So our first trial balance in the accounting cycle is an unadjusted trial balance. Once we have our unadjusted trial balance, we can determine which of these accounts potentially could need to be adjusted. Do you think that we might have used that part of our supplies during the month? Right? Perhaps some of our prepaid rent. Maybe we have earned part of this unearned revenue. You think? We would need to adjust anything that we would need to defer. Again, I believe I said earlier that a deferral is an adjustment for something that is already on the books. So these fall into categories such as we have the supplies that we've already purchased and we need to move them into an expense account. We have a prepaid rent, prepaid insurance, something that is an asset that we need to move into an expense because we have now used part of it up, or we have our unearned revenues that we've now earned part of, so we need to move them from that liability account to the revenue account. Those are deferrals. Depreciation, if we have a plant asset such as a building or land improvements or machinery, anything that has a life of longer than 1 year, then we should depreciate or allocate the cost of that asset over its useful life. We will learn several different methods of depreciation when we get to, I want to say Chapter 7, but it could be Chapter 8. I don't remember which chapter is the depreciation chapter right this second. And at any point in time, we would need to know our carrying value or book value on that asset, which we would determine by the amount of depreciation that had been accumulated over its life and its historical costs, of which we recorded it when we bought it. That's our depreciation. And then we have our accruals. What is an accrual? An accrual is something that has not yet been recorded. So we may have sold something to the customers right at the end of the month, but they hadn't yet been invoiced yet. So we need to complete that invoice to get that sale on the books. Maybe we have earned interest on a savings account, but we have not yet received that interest, so we haven't recorded it. We need to record what is due to us at the end of the month. Or the same token is true for interest that we might owe to someone. Even though it's not due on the 31st of the month, we need to get that amount recorded so that when we pay it the next month, that expense was actually in the month that matched against the revenue. Salaries and taxes, payroll taxes, well, almost any company is going to have accrued salary at any point in time because most companies do not pay right on the day that they've worked up to. Most companies, you wouldn't work Monday through Friday this week and walk out of the office on Friday this week with the paycheck for Monday through Friday of this week. You may walk out with the paycheck for Monday through Friday of last week or the prior week, but typically you wouldn't walk out with the same week. And I say typically because there are some professions that it doesn't work that way. I know lots of doctors get paid for the month prior to when they work. They get paid previously to the month that they're going to work, and I always found that kind of interesting, but different people get paid differently. So most hourly workers and salary workers, however, do get paid with some withholding period. Okay. And this just flips us through it. So if we're going to adjust a prepaid account here, then we would have our cash payment recorded before the expense. So again, we talk about rent, supplies, insurance, advertising. Those are common prepaid accounts that we pay in advance. Almost everybody, that's a generalization too, but many folks pay their car insurance for more than 1 month at a time. So if you pay your car insurance in 3-month increments, you would have prepaid insurance on your books because the insurance company would either owe you the insurance for 3 months or they would have to give you a refund. So here's an example of rent. Let's suppose that Freddie's Auto Service prepays 3-month store rent, $3,000 on June 1st. The entry for the prepayment of the month's rent is as follows. They record their rent, their prepaid rent, and they spent the cash. To journalize it in the T accounts, we had the debit of $3,000 to prepaid rent, the credit to cash, the second, or at June 30th, the rent carries the balance of $3,000, and we need to know how much rent expense was incurred in June. Well, 3 months divided by 3 is 1,000, and therefore our rent expense for June was 1,000, and we would reduce our prepaid rent account by 1,000. Notice our balance is now 2,000 here in the prepaid rent account. And here we bought some supplies, and these are all in your book. I'm going to click through them pretty quickly. These very examples are in your book, but this is where we purchased the supplies. Then at the end of the month, we went to our supply cabinet. We counted what was left, and we have $400 worth of supplies left. We had $700 to start with, $400 left. Then how much do we need? How do we get our balance of $400 down here? Doesn't really look like a 4. We need to know what this number is. So if we do the math, 700 minus x equals 400. We solve for x. We're going to get the $300. Okay, let's see if you can answer this question for me here. At the beginning of the month, supplies were $5,000. During the month, $7,000 worth of supplies were purchased. At the month's end, $3,000 of the supplies are still on hand. What is the adjusting entry? I would tell you the way that I would solve this is always to start with the T account. This is my supplies. If I had 500 at the 5,000 at the beginning, I purchased 7,000 more. which would have been $7,000 supply and $7,000 either accounts payable or cash. And at the end of the month, I had a balance of $3,000. So again, I need to know what's this number. So 5,000 plus 7,000 minus X equals 3,000. And that gives us 9,000. As you see, they showed you just subtract it this way, but it's really by taking the 5,000 plus 7,000 minus 3,000, which is how I do it too on one this simple. But if I'm trying to solve something more difficult, then I always like to set it up in an equation and solve for that unknown. So I like to teach students to use that T account as guidance to solve. So supplies expense 9,000 and supplies 9,000. Plant assets, again, are long-lived tangible or fixed assets such as land, buildings, furniture, and equipment. We record these as an asset when purchased when we were talking about these in Chapter 1. I may be losing my internet here. Something's beeping. When we were talking about these in Chapter 1, we talked about the historical cost of recording long-lived assets. So if we bought a piece of equipment and we had to have some freight to bring it in or pay insurance to get it there, or we need to do some type of setup, everything to get it ready to work or be used for the business was part of its historical cost, of which we recorded it on the books at its historical cost. And then once it declines in usefulness, we record that expense over its useful life. For this chapter, we talk about using just straight lines, so it's much easier, and it will also tell us what amount to depreciate. So again, depreciation is the process of allocating the cost to the expense for the long-term asset. And keep in mind that land does not depreciate. It stays on the books for whatever we pay for it. So if I have equipment purchased, that's what this is an example of. I purchased a piece of equipment for $24,000 on account. Well, that was my example. Okay. Our information relating to that is that it's going to remain useful for 5 years and then it will be worthless. Therefore, it does not have a residual or scrap value. One way to communicate the amount of depreciation for each year is to divide the cost of the asset, $24,000 in our example, by its expected useful life of 5 years. In this procedure, it's called the straight line depreciation. It's going to give the annual depreciation, and then they're going to look at the monthly depreciation as well. So over 5 years is $48,000 per year. If I want to know the monthly, I would divide that by 12 months to get $400 per month. So my depreciation for June would be the $400. And here's what I want you to notice. I want you to notice that the account that we debit is the depreciation expense. Okay. Usually you will see a depreciation expense for each type of asset, but you may not necessarily see that. Some companies just has one depreciation expense account. You should see, however, an accumulated depreciation account for each and every asset on your books. This is the account that is a contra asset. It's contra asset. As a contra asset, if you look at the rules of accounting, you would see the assets increase on the debit side. Contra, meaning opposite or offsetting. The normal balance of a contra asset account is a credit, right? That's our credit column, and this is our debit column. Okay, so it's important to remember that. Every single adjusting entry for equipment will look exactly like this. If it was a building, it would say depreciation expense building, accumulated depreciation building. There's no mystery to what accounts to use when you are adjusting for depreciation. It's always depreciation expense, accumulated depreciation. The accumulated depreciation account shows the sum of all depreciation expense over the life of the asset. The balance increases over the asset's life. It's a contra account, which I just said, with a normal credit balance. A contra account has two distinguishing characteristics. It always has a companion account, and its normal balance is always the opposite of that companion account. So does this lead you to think that we'll run into more contra accounts? We absolutely will run into more contra accounts. In this case, accumulated depreciation offsets the asset, that is its companion account. We'll have allowance for bad debts, which will offset accounts receivables. We will have sales discounts, which will offset sales. And those are each contra accounts, and there are many more contra accounts as we move forward through the textbook. How do we calculate the book value or carrying value? I want to point that out. You will hear me using these terms as synonymous terms, and you will hear other people using these terms as synonymous terms. You can run into textbooks that some might say book value and never call it carrying value at all, and you may run into textbooks that do the opposite, call it carrying value. And all that is your actual historical cost of the asset less than any accumulated depreciation to get you that book value. And I want you to note that this is the balance sheet, and this would be the presentation on the balance sheet of how we would show if we had land as a fixed asset or plant asset, equipment as a fixed or plant asset, and we had accumulated our $400 in June, remember, to get a carrying value of $23,600. And our total plant assets in this case would be $41,600, and that's exactly how that should appear on the balance sheet. What do you think the book value would be of this piece of equipment at the end of July? Well, we actually would have at the end of July, we would do another adjusting entry of depreciation expense and accumulated depreciation of $400, which would increase our accumulated depreciation to $800. So $24,000 minus $800 would make our book value $23,200. As we look at Starbucks financial statement here, it took my eyes a minute to focus on this. We had store equipment, leasehold improvements, buildings, roasting equipment, furniture and fixture. So we had a total of property, plant, and equipment where we add those items together. And then we had a total accumulated depreciation to show our property, plant, and equipment net. This is just the way that Starbucks is reporting theirs. They're not itemizing each item. You would not itemize each item. You would keep a subsidiary ledger of where you were tracking each particular piece of equipment or property, and that's called a depreciation schedule. If you've ever done books or own business and you had an accountant or someone doing your taxes for you, they would have provided you with a depreciation schedule as well for your fixed assets. So how do we adjust accounts? We have accrued expenses. These are expenses that have been incurred but not yet paid, such as salaries, taxes, interest, and rent. So how do we do that? We would say we had employees who earn a monthly salary of $1,800. Half of that gets paid on the 15th and half on the last day of the month. The following calendar year for June has the paydays circled. Assume that if a payday falls on a Sunday, Freddie pays the employee on the following Monday. Okay. So in this case, the payday ended on the 30th, so he pays them on the Monday or on the 1st. So during June, He paid his employees for the first half of the month's salary on June 15th. Just record the $900, no problem. But what happens on the 30th? He's not going to actually pay him, but this cost has been incurred. So we need to record that salary expense, and it's a salary payable. So as you can see, our expense for the month is actually the whole $1,800. We have accrued this $900 salary. We have one income statement account, and one balance sheet account, following the rules for our one of each type of account for every adjusting entry. If we have accrued revenue, the revenue has been earned but not collected, as it is called an accrued revenue. So services performed, rent, or perhaps interest again. So we have accounts receivable and service revenue. The service has been provided. We have not collected the cash for it. We've got to put it on our books. So what about if we have a note receivable, meaning someone owes us money, and us as the company, and at the end of June, $100 worth of interest revenue has been earned. Journalize the accrued revenue adjustment. Now, it's earned, but we have not collected the cash. So what does that entry look like? Interest receivable and interest revenue. Will we actually collect the cash for this sometime next month? Then we would debit cash and credit interest receivable. Unearned revenues, such as we've provided services, or we got paid for services we have not yet provided, and then we earned them. These can be customer deposits. Airline tickets is a good example. We always buy our airline tickets in advance, not always, but usually. Magazine subscriptions, you might pay a year in advance, and then the publisher has to send you out those subscriptions on a monthly basis or weekly basis. And rent is another example. So Home Depot decides to pay Freddy's in advance to service their trucks, and they pay Freddy's $400 monthly, beginning immediately. If they collect the first amount on June 15, then Freddy's records of this transactions are, he got the cash, and now he has unearned revenue. That becomes earned revenue when he starts doing the service on the truck. So at the end of June, he has earned $200 worth. Notice that we take it out of the liability account with the debit because liabilities increase on the credit side. And service revenue is increased by $200 because we have now increased our revenue. So keep in mind that if we have prepaids, we receive the cash first. If we have unearned revenues, we have received the cash first. Right? Accrued, the expense has been accrued, but we haven't yet paid the cash. And accrued revenues, the work has been performed, but we haven't yet received the cash. So the two main purposes of the adjusting process are to make sure we measure income and update the balance sheet correctly. Therefore, every adjusting entry affects both the following: revenue or expense to measure the income, or an asset or liability to update the balance sheet. Every single entry, journal entry. So this is just to summarize. A prepaid expense is going to debit the expense and credit the asset account. Depreciation will debit the expense account and credit the contra asset. Accrued expenses will debit the expense and credit the liability. Accrued revenues will debit the asset, which is an account receivable, and credit the revenue account. And unearned revenue will debit the liability account and credit revenue. So we also would typically have income tax expense accruing all year long. So that's another accrual entry that we want to get on the books, income tax expense and income tax payable. So I'm going to click through a couple of these. And this is just posting all of those adjusting entries that we've done, all the entries we've done. And once we've posted all those entries, we simply go back and do a trial balance. A trial balance is the same process every time. The unadjusted, we've done the journal entries, transactions during the month, recorded them in the journal, and then posted them to the ledger. That's our unadjusted. Adjusted, we have now completed our adjusting entries, posted them to the ledger, updated our balances in our ledger, and then we have to run another trial balance to make sure our debits and credits are still in balance. And then we use that as a source for preparing our income statement, balance sheet, and statement of retained earnings. So this is an example of basically a worksheet, which is a document to help facilitate the closing process. And so it shows that we have, or the financial statement process. Here's our unadjusted trial balance. This is the unadjusted, as we talked about early. Okay, and then these are our adjustings. We can adjust these here. We still have to do the general journal entries. If we do not do the journal entries or the transactions, we have done nothing. We know what amount to put on our balance sheet and on our income statement based off of our worksheet, but we do not know, or we have not updated our ledger account, so we have not formalized the process. So this is an example of a worksheet where we had accounts receivable. If I look at this debit entry here of $300 and this credit entry here of $300, I can tell you that we recorded some accrued revenue, and that was our $300 entry. And then we have $2,200, a debit. If we have a debit here and a debit here, those would be added together. Notice on supplies how we have a debit here and a credit, so it's subtracted. Okay. And notice that when we get down here to the bottom, and we are going to, for each balance column, trial balance, we'll have equals 89.3, 89.3. We had equal debits and credits here of $3,700, equal debits and credits in our adjusted trial balance of $91.5, $91.5. Okay. So this is just another little example that we'll walk through. If we have business has an interest expense of $1,200 that must pay early in January, and it's December 31st, our adjusted entry is going to record that as an interest expense, debit, because expenses increase on the debit side, and interest payable because it's a liability, and liabilities increase on the credit side. So if our supplies have an account, our supplies account, well, let me rephrase that. The unadjusted balance of the supplies account is $3,200. The total cost of supplies on hand is $1,500. Then what's my adjusting entry? I need to record supplies expense of $1,700, the 32 minus 15, and take those out of my supplies account of $1,700. We have salary expense of $7,000 per day, Monday through Friday. The business pays employees each Friday. This year, December 31st falls on a Wednesday. How much is our accrued salaries? We will have salary expense and salaries payable of how much. If it's 3 days that we need to accrue, Monday, Tuesday, and Wednesday, that should be $2,100. If my math comes out right. Yep. 21,000, I guess. I dropped a zero. Did a slide. So salaries expense and salaries payable. On July 1st, the company collected $15,000 in rent in advance. It debited cash and credited unearned rent revenue. The tenant was paying for 1 year's rent. And so now it's December 31st. So how many months have passed? This would have been for the whole month of July, all the way through the whole month of December. So that happens to be 6 full months. So 15,000 times half the year, 7,500. Unearned rent revenue would be reduced by 7,500. Rent revenue would be increased by 7,500. We would now have a balance in our unearned revenue, rent revenue of $7,500. We had interest revenue of $900 that has been earned but not received. We will have an interest receivable and an interest revenue to put on our books. We have equipment that was purchased at the beginning of the year at a cost of $50,000. Its useful life is 5 years. There's no residual value or scrap value. Record the depreciation. 50,000 divided by 5 using straight line is 10,000 per year. The accounts are always depreciation expense and accumulated depreciation. So if the, let's see, equipment was purchased at the beginning of the year at a cost of $50,000, determine the equipment's book value. It was purchased at the beginning of the year, so we had the $50,000 minus the $10,000, and that gives us $40,000 as its book value or carrying value as it would show on the balance sheet. Once we have our adjusting interest done, we are now ready to do the financial statements, not before. We need to have our adjusting interest posted, our adjusted trial balance in balance, and then we're ready to go. So we're right back to, we want to make sure, point out a few things here. An income statement is for a period of time. In this case, for the month ended June 30th. We will list our service revenue less each individual expense to get our income before taxes. If you remember, we had a little income tax expense in this example to get our net income. The next step we do is the statement of retained earnings to update our retained earnings account. And again, we have for the month ended or a period of time, our beginning retained earnings plus our net income, which we calculate above and move down to get our total there, less any dividends we paid out to get our ending or updated amount for retained earnings. Where does that amount end up? On our balance sheet, right? It goes down to our retained earnings on our balance sheet. We will list our assets. Notice again over here where we're listing our plant assets, how we are showing we have equipment less our accumulated depreciation. Right? Our liabilities and our stockholders' equity. Again, these items should be listed in their order of liquidity or things that can be converted to cash the most quickly. And the last step in the accounting cycle then is to close the books. We need to zero out our temporary accounts. We'll zip through the slides, and then again I have the example to look at when I get that far. Closing the books. We're going to zero out our temporary accounts or nominal accounts, and we leave open the real or permanent accounts. So what do we close? We close our revenues, we close our expenses, and we close our dividends. If you notice this, we close each of these accounts to retained earnings. So we'll go through the process and you can look at that, but I will tell you that you always close the red accounts, R, E, D for red. It's a memory hook, right? Which accounts do I close? Revenues, expenses, and dividends. Revenues have a normal credit balance, so to close them, I must debit them because my goal is to zero them out. Expenses have a normal debit balance, so to zero them out, I must credit them. And dividends also have a normal debit balance, so to make the balance zero, I must credit them as well. Another thing that you might find interesting as we look at just this little diagram here is that we would credit retained earnings when we close revenues if, let me just go ahead and pop this up real quick. So as we look at retained earnings, we see here that retained earnings actually increase on the credit side. Well, so do revenues. So a credit plus a credit increases our retained earnings. And we were looking at that to zero out an expense. We had to actually credit the expense, which means we had to debit our retained earnings. And when I debit my retained earnings, I'm reducing my retained earnings. And if you think all the way back then to the statement of retained earnings, we actually started with our beginning retained earnings less net income. Well, what is net income? Net income is revenue minus expenses, right? And so this is just a way that we're doing that same process, only we're doing it in the closing out or zeroing out. We're updating that retained earnings account through the closing process. Just doing the statement does nothing. We have to do the journal entries. Okay, so that process. So we have a little diagram either in the book or on the slides here of how we are going to close these temporary or nominal accounts. So to close the books, we debited our service revenue, credited retained earnings, debited retained earnings, listed each of our expenses as a credit, and to zero out our dividends, we credited the dividends and debited retained earnings. If you look at your retained earnings account in this case, then you see that we come up with an ending balance of $18,500, which is exactly what would have been on our final balance sheet. Here it also shows how we are zeroing out each of these accounts. The balance would be zero. So let's look at the closing entries of this Westmont Services Corporation. We have cost of services sold. It's our cost of goods sold account. $28,600. Accumulated depreciation, general selling and administrative expenses, retained earnings, service revenue, depreciation expense, interest revenue, dividends, income tax expense, and accounts payable. Do we close all of these accounts, or are some of these accounts permanent accounts? Some of these accounts are not temporary accounts. They are accounts that carry a balance at all times. We do not close retained earnings. We do not close accounts payable, right? We do not close accumulated depreciation. It is a contra asset account. We do not close assets. We close revenues, expenses, and dividends. Okay. Everything else looks like a revenue or an expense or a dividend, right? Sure do. So cost of goods sold is an expense that doesn't end in the word expense, or cost of services sold. So we always want to close a revenue first. We had revenue of $63,800. We had interest revenue of $800. Therefore, we increased our retained earnings by $64,600. For our expenses, we had a total expenses of $50,800. Those were our cost of services sold, our general selling and administrative expenses, our depreciation expense, income tax expense. And last but not least, we had our dividends, which we need to reduce our retained earnings by the amount of $600. So that's the closing process. I often tell students again in face-to-face classes, let's not make the closing process harder than it is, because the closing process is just simply not hard. You have your financial statements completed, you look at your financial statements, and you want to make sure you zero out every item that's on your income statement, and you want to zero out your dividends, and you're done. So how much net income? Can we tell how much net income this company had by just simply looking at the accounts here? Again, we have to figure out what we need to add together and what we need to subtract. Or we could just go back to our closing entries and look at those as well. But if we go back to our closing entry, we can see that we had total revenue of, let me go all the way back here. We had total revenue of $64,600. We had total expenses of $50,800. So you add your revenue minus your expenses to get your net income of $13,800. Did I say 13,800? Yeah. And then we would subtract our dividends from that. So again, one more thing we talk about, and I already threw the word liquidity around a little bit, but we need to classify our assets and liabilities based on their liquidity, or how fast they can be converted to cash. Since cash is already cash, it's very liquid. It is the most liquid asset. Accounts receivables are relatively liquid because cash collections usually follow quickly. Another way you can turn your accounts receivables into cash is by factoring them or selling them off to another company for less than their face value, but you can still raise cash pretty quickly. Inventory is less liquid because inventory must be sold, so someone has to walk in the door that actually wants what you're selling before you can sell it. Equipment and buildings are even less liquid because they're not for sale. And even if you do decide to sell them, it takes longer to sell them. And assets and liabilities are presented again, in the order of liquidity, how quickly they can be converted to cash. So when we classify assets and liabilities, we want to list current assets and then the long-term assets on our balance sheets, and then current liabilities, then our long-term liabilities. So current should be converted to cash or sold or consumed within 12 months. Long-term is anything over 12 months. Let me go back here a second. Looking at this long-term asset, I want to point out that we also have long-term investments, intangible assets, and other assets. Intangible assets are things such as goodwill, patents, copyrights. It might be a mailing list, a customer list. Customer lists are items that you might buy and they have value, that type of thing. Things you can't see, touch, or feel. Current liabilities, again, the debts must be paid within 1 year. And long-term liabilities, anything that are not classified as current. So you might have a mortgage, although if you have a mortgage payable, 1 year of it is current and the rest of it is not current. It's long-term. You might have a note that's a 3-year note, and you don't have to make any payments on it until the 3rd year, so that would clearly be long-term. Anything you're making payments on, however, part of that is current and part of it is long-term and should be classified as such. There's 2 different forms to the balance sheet. So far we've been looking at the account form of where we have the assets on the left and the liabilities and stockholders' equity on the right, and then there's a report form. With the report form, you list your assets first, then your liabilities and your stockholders' equity right down the page. Income statement, we have the single step where we would list all revenues that we had in the business, and we have the multi-step of where we list our sales less our cost of sales to get our gross profit, and then other revenues and expenses are listed below that. So Exhibit 314 in your textbook gives you a good example of a classified balance sheet. It shows how you would list your actual current assets, then your long-term assets, property, plant, and equipment. So here I have goodwill. Goodwill is something that ends up on your books when you buy an existing business and you pay more for it than what the fixed assets are appraised for. So if the building and the equipment for a restaurant were appraised for $100,000 and you paid $125,000, you would have $25,000 goodwill. And that is amortized, which is similar to depreciation once it's deemed not valuable any longer. So here's an example of an account form where assets on the left, liabilities, stockholders' equity on the right. Single step income statement, revenue, then expenses listed below that. A multiple step format shows our net revenues less our cost of sales. For our gross profit, then typically we would have selling expenses and general and administrative expenses listed separately. And then our gains and losses actually go in an other gains and losses section because we're not in business to make a gain and we're not in business to make a loss. We're in business to create revenue, which is sales in a business. Okay. Got crazy. Analyze and evaluate the company's debt paying ability. This is just going to be a ratio. We're going to look at current assets minus current liabilities to get our net working capital. This is to be considered sufficiently liquid. We should be able to have sufficient access of current assets over current liabilities. It would worry me, as I think it would worry each of you, if you had income of $10 and your expenses were $15, then we're clearly not liquid. It would be better to have income of $10 and expenses of $5 than it would be to have income of $10 and expenses of $9. So each of those, you know, it's just a different way to look at how liquid your company is by looking at your net working capital. The current ratio, we've seen this before. We'll see it many times throughout the chapters. Total current asset divided by total current liabilities. It measures the company's ability to pay current liabilities for current assets as they come due. Most successful businesses operate with current ratios between 1.2 and 1.5. An example of that would be the 1.5 would be that I had, well, I say that now, again, I'm gone real quick here. Go over here and do if I had assets, I'm trying to do 50. If I had assets current assets of 100,000 and current liabilities of 50,000, my ratio would be 2 to 1. 100,000 divided by so we can play with that number any way we want. If I had 150 to 60, it would be 2.5. If I had 150 to 100, there's my 1.5. So if I had $150,000 worth of current assets and $100,000 worth of current liabilities, that would be 1.5. So, you know, it would just be the company's comfort level. It would not be good if it's less than 1 to 1 at all. So a higher current ratio is better. We'll look at you'll have some homework problems, I believe, that where it looks at, here's your current ratio. Now, what if this happens? How would that affect your current ratio? So we'll look at this example here. We issued stock and we received $50 million cash. So how would that affect our current ratio? If our current ratio before was 4,200 divided by 2210, then that was a current ratio of 1.9. Where students get tripped up with this kind of thing is they say, okay, I got 50,000 cash, I got 50,000 or million common stock, and they add 50 to both sides. But the only current item we have in this transaction is cash. And so that's a current asset. You add it to the current asset side, and you have more cash.